Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the corporate world's most complex documents. And today we've got a report that is all about getting deals done, sometimes by any means necessary. Before we dive in, if you love breaking down SEC filings into simple, actionable insights, make sure you are subscribed to the channel. And a quick shout out to our Discord community. Join us in the description below for more real-time discussions. Alright, let's get straight into this Form 8K filing from Rising Dragon Acquisition Corp. This isn't a deep dive into years of financial performance, but rather a snapshot of a critical event for what looks like a special purpose acquisition company, or SPAC. Think of SPACs as companies formed solely to raise money through an IPO, with the specific goal of acquiring or merging with an existing private company. This filing is about a financing move to keep that acquisition process alive. So what is the big news here? On the 14th of January, Rising Dragon Acquisition Corp, or RDAC as they're known, issued two short-term loans, each for $50,000. These aren't your typical bank loans. One is from their sponsor Aurora Beacon LLC, and the other is from SEG Limited, which sounds connected to a prior merger agreement. Now, here is the crucial part. These loans, called promissory notes, don't charge any interest. That is good for the company. They're due when the company eventually closes its main business deal, its initial business combination. The money from these loans is going straight into the company's trust account, which is like a holding place for funds raised from the public. Why is this deposit so important? It is to extend the deadline for Ardisec to find and complete a merger. They've pushed this window to the 15th of February 2026. This tells us they're racing against time to secure a deal. SPACs have a limited lifespan, and if they don't find a target company to merge with by their deadline, the SPAC usually dissolves, and investors get their money back. There is another interesting detail here. The people or companies holding these notes have the option to convert them into company units. These units are the same ones that were sold when RDDAC first went public. This means the lenders are effectively betting on the company's future success, hoping the units will be worth more than the $10 per unit they could convert them into. It is a way to incentivize the lenders to support the company's extension. Let's quickly look at what is actually traded. RDSAC has units, ordinary shares, and rights. The units themselves are a package deal containing one ordinary share and one right. The ordinary shares are the main stock, and the rights give holders a chance to get more shares later on. All of these are listed on the Nasdaq Stock Market LLC, which is a major exchange. The company has checked the box indicating it is an emerging growth company. This means it can take advantage of certain regulatory flexibilities, like having a slightly longer period to adopt new accounting standards. For investors, this can mean less immediate disclosure on certain financial reporting fronts, but it is common for companies at this stage. Looking at the signatures, Lulu Xing is listed as the Chief Executive Officer, signing off on this report. This is the person in charge of the company's day-to-day operations and strategy. Now let's zoom out and think about what all this means. This filing isn't about booming sales or massive profits, because that is not what RDSAC does. It is a shell company. Its whole purpose is to find and merge with another business. These promissory notes are essentially a bridge, a way for the company to buy itself more time to strike that crucial deal. The fact that they need to extend their timeline and are using these convertible notes suggests that finding an attractive merger target hasn't been straightforward. The key risk here is time. SPACs have a ticking clock. If RDA can't complete a merger by the new deadline in February 2026, the cash raised in their IPO will likely be returned to shareholders. The holders of these promissory notes are essentially giving the company a lifeline, but they're also positioning themselves to benefit if a deal does close. If the value of the company's units increases significantly after a merger, then their conversion option becomes very valuable. The company's direction is entirely tied to the success of its merger plans. The strengths lie in their access to capital through their IPO and now through these bridge notes. The weaknesses are the inherent uncertainty and time pressure of the SPAC model. A significant opportunity would be finding a high quality target company that presents strong growth prospects. A major risk is simply failing to find a suitable partner before their deadline, which would lead to the SPAC's dissolution. In conclusion, this is a necessary step to keep the acquisition process alive. It highlights the pressures RDC is under, but also shows a commitment from its sponsor and partners to push for a deal. Whether they succeed will depend entirely on their ability to find and close a merger that creates value for shareholders. Alright, that is our quick decode of this 8K. What is your take on these SPAC financing maneuvers? And do you think RDSec will find a merger partner in time? Let us know in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more regular insights into corporate filings. And don't forget to join the conversation on our Discord server. The link is in the description. Thanks for watching, and we'll see you in the next one.